Welcome to the House Rules, the gaming compliance podcast from the Association of Certified Gaming Compliance Specialists. In this podcast, we will hear from casino and iGaming compliance specialists, discussing the latest trends and hot topics impacting the industry. We will also be focusing on careers in compliance, hearing from seasoned professionals about their own career paths and sharing their expertise and insights. In this episode, join Gregory Dellas for a discussion surrounding PEPs, UBOs, trusts and other high-risk customers, and the requirement to conduct effective enhanced due diligence.
So a few words about me. I'm actually working and living out of Cyprus. And I've been working for over 22 years in the Cyprus banking sector, mainly in private banking and wealth management, largely in compliance roles. I'm now with ECOMBX. ECOMBX is a fintech. It's an electronic money institution licensed and operating out of Cyprus for the last almost 3 years. I'm with ECOMBX. I am also the chair of the ECAM Cyprus chapter since 2015 when we launched it in Cyprus, and I'm working with ECAMs on the development of almost all their new certifications, cooperating in things like trainings and conferences. Also working with other organizations across the globe, like GCI in Australia. And I'm also the vice chair of the Association of Cyprus EMIs and PIs. And I've worked with Ian actually for the last 2 years on the 12 mentor-mentee program, even though it's the first time we're interacting over Zoom. So it is a very practical session. We'll talk a bit about high-risk customers. We'll talk a bit about how what high risk means and how we can go about performing our due diligence practically. It doesn't matter what industry you operate in. Due diligence is due diligence, and you adapt your requirements on the industry. When writing the title for today's presentation, this, knowing me, knowing you phrase came to mind. I'm not sure if anybody can tell me what the title means. I asked a couple of people at the office today, but they're apparently younger than I am, so they couldn't tell me where it comes from. But it actually comes from an ABBA song. This is what due diligence is all about, really. It's about knowing our clients well. And that is how we should perceive it and how we should be able to explain it to the customers when we're asking those difficult questions. So when we sign a contract with our customers, be it in banking or gambling or gaming, we essentially enter into some kind of marriage. A marriage that usually only works when there are no secrets, when there is transparency, and when there is a mutual understanding of what we're trying to do, what services we're trying to provide, and how the services will be provided. And we need to be equals in this relationship, which is essentially based on trust. And I will start by saying that customers are good. And I will use this phrase a few times today. They're innocent until proven otherwise, because sometimes we actually get carried away and we treat them as being guilty, and even asking them to convince us, how innocent they are instead. With that said, let me jump into today's objectives. We'll talk a bit about what defines a customer as high risk. We'll talk a bit about complex corporate structures and other types of high-risk customers, including legal arrangements. We'll talk a bit about shell companies, and also, obviously, practical enhanced due diligence for building a useful customer profile. Again, please free to jump in using the chat, with any questions or comments you might have. So I have a question for you. What is a high-risk customer? And obviously, a high-risk customer is a customer that poses higher than average risk for money laundering or financing of terrorism. But should we actually avoid these customers? A lot of times when you talk to people in financial institutions or other sort of industries, they say, we have a great policy on customer acceptance. We simply avoid, the higher risk customers. And there's been a lot of, discussion and talk about de-risking across the world on various types of industries, various types of businesses, including in some cases casinos or gaming. And actually the truth here, I mean, the answer to this question, in my opinion, is that it depends. It depends on the level of risk. It depends on your own risk appetite, which is driven by your ability to manage the risk. And it depends on the risk appetite of your institution, which reflects on that ability to understand the risks that your customers are probably posing to the organization, and to what extent you have adequate controls in place to be in a position to mitigate the risk and allow good businesses or good business to go through. Because essentially that's why we're here. We're here to allow good business to go through. And remember, clients are good, and we want and we need the good clients to use our products, to use our services, so that we can carry on doing our business and we can carry on bringing food to the table for ourselves and our families. So your clients, your client base, all the people who use the products and services that you offer, basically anyone who wants to establish a relationship with a financial institution can be a client, but financial institutions obviously do not want every client. Casinos do not want every single client. They want the good clients. So those clients which will be within the risk appetite of the financial institution. And to get there, we need to apply a risk-based approach on how to handle those clients. And that would be your customer risk assessment methodology that will help you risk rate the clients and define which clients pose a low risk, which clients pose a medium risk, which clients pose a high risk, or which clients are prohibited in terms of how ready you are to take on the risk they bring with them. And this means basically two things. First, you need to know your customer. And second, you need to know the risk associated with this customer. So who are your clients? Are they individuals? Are they legal entities? If you're working for a financial institution, are they financial institutions themselves? And all of this is important to consider within a risk assessment. So normal retail clients, individuals who want a basic day-to-day account from a financial institution could perhaps pose a lower risk than foreign high net worth individuals. And it's the same, again, across every industry. And again, if you're working for a financial institution, if you're looking at multinational publicly traded corporations, they usually have a lower risk than private companies because there is transparency and there is much more publicly available information, and due diligence is easier for a corporation listed in a major stock exchange. You know, a few years back when I was doing my CAMS exam, and now it seems like a long time ago, I was working for a bank, right? But I was sort of forced to read about all the different industries, and I wouldn't get a lot of things out of that, out of the training, out of that discussion, out of that study guide. But then I realized that the more you know about how risk is defined across the different industries, the easier it is for you to understand how risk is mitigated in your industry, because you deal with a lot of people, right? You don't just deal with your own industry, you deal with people, you deal with people wherever, whichever industry you're working in, you deal with people from across different practices or industries. So going back to our risk assessment, by conducting a careful risk assessment on your clients, you consider things like the very nature of the customer, like who the customer is, how is the customer structured, is the customer an individual or a legal entity, the type of legal entity or legal arrangement, what is the industry the customer operates in, the source of funds of the customer, things like the customer's background, but also the risks that come with the jurisdiction the customer is registered, located, or born in, or operating, or does business with. We look at the product or the service the customer intends to use, and take into account the vulnerabilities of that product to misuse, and also take into account how the customer will interact with us, and how the product is delivered to the customer, and how the customer came to us. So if you are operating a land-based casino, you have different risks to face than if you're operating an online gaming or gambling business. And again, things like reliance on third parties, for example. And we look at some of these as we move along the presentation. So examples of some high risk situations, we'll look at some of these today. PEPs, politically exposed persons. We'll look at how these can bring about a bit of risk. Private banking, if you're working for a financial institution, or if you're dealing with customers that are enjoying private banking services. Shell companies, there's been a very big discussion across the world, but mainly in Europe about this, and Cyprus, actually, where I come from, did a lot of things from the regulatory perspective to deal with shell companies. It's a bit rigid. It's a rigid approach, but it sort of works. Complex structures, legal arrangements, and we talk about trust and foundations, different jurisdictions, including tax havens or secrecy jurisdictions. And this is what I meant before by knowing the country risk, where your customer is exposed, where you are exposed, and where the your customers are dealing with which jurisdictions, or where their customers are, perhaps. Talking about pool or client accounts or omnibus accounts, but also other high-risk situations could be gaming or gambling, businesses. And if you're working in an industry, for example, if you're working in a gaming business, it's really important to understand how you are perceived from the outside, right? So I'm working for a financial institution. A lot of times when we're dealing with correspondent banks, for example, who perform transactions on behalf of our customers, they sometimes avoid specific industries because of the risks those industries pose, and also their ability or our ability to manage those risks. So a lot of times we might think that our business is risk-free or is low risk because we're actually working in that industry, but it's really important to manage the business well. It's really important to understand how the business is perceived from the outside. I don't see any comments or questions so far, so I'm moving on. Talking a bit about PEPs. And what are PEPs? And again, that affects a lot of different industries. A PEP is essentially somebody, a natural person who's been entrusted a government position, a prominent public function, like a head of state, president, or prime minister, ministers, deputy assistant ministers, members of parliament, or similar legislative bodies. I'm taking this definition from the European regulation, but obviously very similar definition applies across the globe. Members of governing bodies of political parties, members of Supreme Courts. In Cyprus, we include mayors. In other countries, you don't include things like mayors, but we've had our share of scandals with mayors involved in corruption cases. So we decided to include this as well in our definition. Some countries only apply the PEP definition on foreign PEPs. Across Europe, we apply the same definition when talking about PEPs wherever they are. I mean, if they are PEPs within the country, domestic PEPs, we treat them exactly the same way as we would treat a foreign or a PEP who is based or has the public function somewhere else. And the definition of the PEP does not just stay with the PEP himself or herself, but extends to family members, extends to the spouse, the wife, or the husband, or any relationship that the PEP might have, children, and their spouses as well, parents of a PEP, but also close associates, which is very interesting because it's a lot of times it's very difficult to identify who those close associates are, and you might find a lot of information going online, but usually close associates are defined as those natural persons who are known to have a close relationship, a close business relationship, or even a personal relationship with a PEP. And again, it is a very difficult thing to pinpoint. You can find it by looking at the businesses a PEP is involved in, the legal entities the PEP is part of, but also going online and doing a bit of search, you can sort of come down to a conclusion as to whether there is a relationship there, business or otherwise. And actually, it's up to you. The definition of a PEP can extend to things like even if, strictly speaking, according to regulation, especially in the EU, a PEP ceases to be seen as a PEP if they don't have this public function for over 12 months. It's actually up to your own risk appetite and your own policies how to define the PEP in terms of, does this person still have political power? Does this person still have involvement with the government? And there you can decide to treat the customer as a PEP and treat the customer as being of high risk. But where is the risk there? I mean, why are we bothered? Why do we care about PEPs? PEPs usually have access to public funds, and PEPs, because of their position and because of their power, they can be made vulnerable to corruption and other crimes. There was a case in Cyprus a few years ago, believe it or not, with the Cyprus sewerage system, with the sewerage system in a specific city, where the mayor was involved in a corruption scandal by taking kickbacks from giving this big contract for the sewage system to a company. And when he received kickback, I mean, the first thing he was asked was, why did you do this? Why did you receive this money from the company to which you have granted this contract? And the response was very pure and sort of innocent, because I needed money to build my daughter a home. So a lot of times they are caught up in this sort of vulnerability, or this position where they do have the access to public money and they can take advantage of that power. So we're talking about things like corruption, fraud, money laundering, tax evasion, abuse of their power, greed, and so on and so forth. Another thing we scratched upon at the beginning was complex structures, another high risk area. And if you're dealing with a company or with a legal entity that's involved in a complex structure that is set up in a sort of a more complex type of situation, first of all, you need to define what you mean when you say complex structure in your own institution, right? It could be a 3-layer structure with legal persons, with different types of legal entities. It could be a 3 or 4-layer structure with from involving multiple jurisdictions, involving tax havens. It could be a simpler structure involving legal arrangements or other types of entities. So one of the things you should ask is, why is it set up this way? I mean, I've seen, when I was working for private banking a few years ago, I would see a lot of my customers who were not obviously natural persons. They would set up their structures in such a way, in such a complex way, and it was really difficult to come down to the actual ultimate beneficial owner, but also understand why is the structure set up this way. There could be a great reason why you would have a complex structure. For example, airline companies, they set up structures where they set up different companies to hold ownership of the different airplanes they have. The same with ship management companies or companies that own different kinds of vessels around the world. They would set up different structures across different jurisdictions to hold ownership of those vessels, and that makes it easy to sell them or to manage them. But again, you should ask, why is the structure set up this way, and does it actually make sense? Who is really in control of the activities of the customer? How will money flow through the structure, and interaction of the parties involved in the structure, and the rationale behind using that structure to deal with you and to deal with your own products and services. So if you have if you're facing a legal entity customer who is involved in this sort of complex structure, you need to establish and be clear about who controls the structure, how the money flows, and be in a position to monitor if things change across the course of the relationship. A lot of times we talk about UBOs, right? And it might seem weird, but it is a new concept in some jurisdictions across the world, who were really a lot of times relying on the shareholders. But the shareholder a lot of times might be a nominee shareholder, so not the person who actually ultimately controls or owns the legal entity customer. So a UBO, the ultimate beneficial owner, is that natural person or those natural persons that ultimately own or control the customer and on whose behalf a transaction is being conducted. So whenever you deal with a legal entity or a legal arrangement, you need to drill down to the actual UBO and find out who actually controls the customer and whose benefit any transactions or any dealings will be made. So if we look at these examples here, right? We've got two structures. You could say that they might be complex structures. They have more than 3 layers of ownership. And the presumption here is that the UBO is at 25% as per the EU directives, but also as the it's a global norm to treat UBOs as those persons owning or controlling more than 25%. In this case, the calculation of the beneficial owners will be in accordance with the to the presumption of 25%. So if you look at the first structure on the left, George directly owns 25% of Hotel AS, which is our customer in this case, and is therefore a beneficial owner. Paul directly owns 9.69%, which is essentially the 19% times the 51%, and therefore is not a beneficial owner because he holds less than 25%. Charlie directly owns 15% and indirectly owns 13.24% more. If you do the calculation again, it's 80% times 30% times 51%, which brings you to 13.24 plus the direct 15%. That's a total of 28%.24. So therefore, Charlie should be treated as a UBO. If you look at Suzanne, she owns 3% of Hotel AS and is therefore not a beneficial owner. Rachel indirectly owns 13.27%, right? And is therefore not a beneficial owner. However, you should consider that Rachel has controlling interest in all the companies with 51%. So you should consider where. Excuse me? Does anybody have a question? No, maybe accidental unmuting. So where was I? If we look at the second structure, right? The second structure, individual X that you see in the structure. Give me a second. Individual G, I'm sorry, individual G that you see in the structure. Now, individual G is a beneficial owner, obviously, because they hold 80% of the units in trust, in C trust, which in turn owns 80% of our customer, of APTY, which in turn holds 50% of PTY Limited. This is simple math. It gets complicated because we've put a lot of structures on the way, but you see where I'm going with this, right? You always have to drill down to see, each specific person, what sort of ownership they have and how to treat these persons in the structure, essentially looking for the beneficial owner. I know it's a long presentation, but I was intending to play a game here. And I was intending to ask you to tell me, looking at this sort of structure, who should we treat as a beneficial owner? Because I think despite the time we're giving to this specific section of the presentation, I think this might be the most important part of the presentation, who owns and who controls our customer. Would anybody want to give it a go? I can give you a couple of minutes. If I don't get a response, then I will do it for you. We're looking for one person out of the whole structure. Any ideas? Excellent. I got my first response. So actually, it's not one person. It's more than one person. Excellent. Okay, let's resolve this puzzle. So if we look at these people one by one, right, starting from the left and going to the right of the screen, Mr. Z owns 28% through companies E and B, right? Mrs. X owns 6 plus 6.25 if you do the math. So 12.25% through companies E and B and G and C. Mr. Y, exactly the same situation, holding 12.25%. Mr. X, again, 12.25% through companies F and C. Mr. V owns 12.25% through companies H and D and M, K, J, and D. Mr. W, 15.75 through companies H and D, and Mrs. Y owns 7% through companies L, K, J, and D. So looking at the structure here, it's notable that it is quite complicated by the fact that X, Y, and V exercise beneficial ownership of company A through multiple routes. And this emphasizes, the importance of identifying all the natural persons in a corporate structure, even if verifying the identity might not be required in all the cases under a risk-based approach. In a scenario where a firm uses a verification or identity threshold of 25% for beneficial ownership, actually only Mr. Z would require his identity to be verified because he's the only one holding 28%. But it is a complicated structure. It is a complicated structure because, again, some people exercise ownership through multiple routes in this structure. Despite saying that, though, despite the threshold, the management of risk should not just be based on the planned use of these numerical thresholds, but rather it should be based on analysis and understanding of the circumstances. And this is where enhanced due diligence comes in. Very quickly, a few words about shell companies. Shell companies have been discussed widely across the globe because of the ability of criminals to hide behind shell companies. It is especially, they are quite popular in the sense that they're not all bad. A lot of times shell companies are used for things like holding assets or holding pieces of art or in investments or M&A deals. But essentially what a shell company means is a company with no physical presence, with no operations, with no economic activity or no reason to exist, if I can use that phrase. In Cyprus, we have used a stricter definition for shell companies, exactly because of all the issues we had in the country. It's not bad to accept the fact that you've had issues, because that's the only way to improve yourself. In the legislation, we have a stricter definition of shell companies, which includes the fact that a shell company is a company with no physical presence or operation in the country of the corporation, and that means management and control, and no established economic activity in the country of the corporation, and obviously no documentary proof to the contrary. And economic activity can also mean holding stocks of shares. It can mean holding assets. It can mean facilitating specific deals, trades, or asset management, and essentially legitimate business. So when we talk about economic activity or the absence of economic activity, we mean the absence of a documented, legitimate business. It's a bit stricter because it only talks about the country of the corporation. A more widely accepted definition of shell companies would include those companies that don't have a physical presence or a place of operation or real economic activity anywhere in the world, irrespective of their country of incorporation. That's why I said it is a bit strict. And the Cyprus regulator goes further to say that if you have either of the two elements of that definition that we've seen in the previous slide, then you should avoid or terminate any relationship with that company if it's registered in a jurisdiction where there is no requirement to file audited financial statements, and the company does not voluntarily prepare those financial statements, or the company is registered in a jurisdiction that is defined as being non-cooperative by the EU or the OECD or another global body. Talking a bit about trusts, now it is important to define trust. It's important to define who is the beneficial owner in trust, and that is part of our due diligence or enhanced due diligence process. When we're talking about trusts, we're talking about a legal, it's not a legal entity, but it's some sort of arrangement where you have a settlor, the person who actually holds the assets, who puts the assets in trust with a trustee, and the trust deed, the document that controls how the trust is governed, sort of has the rules of how that property will be managed by the trustee. So the trustee is essentially the legal owner of the trust, but the settlor is actually the person who has provided the assets to the trust. And the trust can have specific beneficiaries, and all these, if we're talking about identifying the UBO, all these people need to be identified because they all have a part to play or a role to play in how the trust is set up and managed. So you would need to know, who the settlor is and where they got the property from. So if you're performing your enhanced due diligence, you would need to go back and find out things like source of funds, source of wealth, and all that has to make sense. The trustee obviously has the legal ownership of the funds or the assets, so they should also be identified. Then you have the beneficiaries, who could be, anybody actually that will be a beneficiary of the property at some point. And in cases where the fund has a protector, and the protector is essentially somebody who has control over the trustee or not the decisions of the trustee, then you should also need to identify and verify the protector, because they basically have control over the trust as well. A lot of reasons why we can set up a trust, for things like tax planning, asset protection, co-ownership, succession planning, and so on. And there are obviously risks because trusts have been used traditionally to hide the actual beneficial owners. They can be used as a tax evasion vehicle in specific circumstances, and a lot of other opportunities for misuse. I think I'll skip a few slides in the interest of time. I see that we are sort of running out of time, and I still have a lot of things to say. But I wanted to emphasize here that in things like trusts and also foundations, what is very, very important is to identify the parties that have control over the trust, who have control over the foundation, and who are also beneficiaries of the assets or the proceeds from these legal arrangements. Okay, just a few words about foundations. One of the differences between foundations and trusts is that foundations are indeed legal entities comparable to companies, whereas trusts are not legal entities. They're legal arrangements. They don't have a defined legal status. And it's really difficult to find a definition of a foundation. I actually was struggling when I was doing a presentation a few years ago to find a proper definition of a foundation. It is described, though, in an earlier FATF paper as requiring property for a specific purpose and a legal entity that can also engage in specific businesses. There is control over what the foundation does in terms of a specific board of directors, and it doesn't have owners, but it actually has beneficiaries. In a lot of jurisdictions, they are also quite regulated. They are created for succession planning or for as a will to manage or administer distribution of money and family property across different persons, but also to hold ownership of different assets, like even legal entities. It has a specific document, which is called, in comparison with the trust, which has a trust deed. Here we have the charter and bylaws, which does essentially govern how a foundation is run, how the foundation is structured, and what the foundation can actually do, including the founders, the protectors, the beneficiaries, and so on and so forth. And again, a beneficiary here of a foundation, of a private foundation, is somebody who is either identifiable by name or by reference to a class. So we're talking about, for example, a charitable foundation. There could be reference to a specific class of beneficiaries who are entitled to benefit under the foundation, under the charter or bylaws of the foundation. Again, why am I going into all this? Is because when you're dealing with these sort of arrangements in a complex structure, again, you need to drill down to understand exactly who's controlling, who is benefiting, and who has ownership of the structure. So it's important to, if you're working, for example, in an industry that deals with these structures and arrangements on a daily basis, it's really important to understand them well and to have proper guidance for your colleagues in the front line to be able to analyze and get an understanding of the controls that need to be put in place to avoid misuse. We still have some time, so I will still. Ian, can we share the slides later?
Yes, we can.
Excellent, because there's a lot of a lot of information here that might be of interest. So I instead of going over the information in the interest of time, I'll just skip a few and talk about things that are most important. Excellent. So again, charitable foundations are perhaps the most the ones that are of most concern. They can be abused for things like tax evasion, tax fraud, but also for terrorist financing, which is a major issue with charitable foundations and charities in general. So it is something that we should be concerned with, and when we're performing our due diligence, we should be in a position again to understand what the foundation is, why it has been set up this way, where it is registered and licensed, who the founder is, and obviously source of wealth of the founder, the identity of those that control the foundations, essentially the members of the foundation's council or the foundation's board. Understand the charter and bylaws, essentially like getting the memorandums and articles of association for the company in a very similar way, receiving and understanding the charter and bylaws and the beneficial owners, obviously, if we are talking about specific individuals. Third-party reliance. A lot of times we rely on third parties to establish a business relationship with an underlying customer. And obviously this presents an additional element of risk, especially where these third parties are not regulated. In a lot of jurisdictions, in a number of jurisdictions across the world, you can engage with a third party who will introduce customers to you where they are not, they don't have the same responsibilities as you do in terms of AML. And one of the things that is and has been of concern is transparency, where you have a lot of different parties involved, like lawyers or accountants or tax advisors who might be looking at the AML or AFC responsibilities a bit differently than you are. And also another risk that is obvious here is the risk of fraud, where these sort of professionals, the third parties, might be misappropriating client funds. So, one of the things that Cyprus was, again, in the spotlight for a few years ago was this over-reliance on introducers, on third parties, especially in the financial institutions, where it was said that they would rely on third parties for the introduction of these customers to the banks, to the financial institutions, but also they would rely on the third parties for the running of the accounts, which was obvious sort of over-reliance on the relationship. And again, it depends on the controls you place in these situations. For example, you might decide that a third party that comes to introduce customers to you, one of the things you need to look at is their own AML policies, their own AML requirements, their own file keeping or record keeping requirements, and decide how reliable they can be in terms of the KYC and CDD that you would need to perform on your customers, or even decide to perform your due diligence directly. So a few slides on EDD. We already talked a bit about it in the different types of industries and circumstances, but essentially, enhanced due diligence requires that we look at things a bit deeper. We look at the relationship a bit deeper. We collect more information. We get a better understanding of the relationship. And the reason for that is because obviously the risk is higher. The more you realize, the more you understand about the customer, the better you are and the more equipped you are to service the customer. So essentially, we shouldn't be looking at this as a burdensome task, right? If you look at a customer who is or perhaps operates in a high-risk industry or deals with high-risk countries, the more you understand the customer, the better you can service the customer. So it has an added sort of benefit that the customer is happier at the end of the day because the service is smoother, the transactions are executed quicker and more effectively. So essentially, what we're looking for in due diligence is to get a good understanding of the customer, a better understanding of the customer in enhanced due diligence, so that we're in a position to identify abnormalities in the relationship. So the more we know about the customer, the better and the easier it is to define or to pinpoint or to pick on those abnormalities. So what is enhanced due diligence? It applies obviously to high-risk customers. It applies to high-risk products and geographies. It applies to high-risk delivery channels. And it involves, again, the collection of more information, the review, the closer review of the information that we collect, and the better understanding of additional data about our customer. What we're trying to achieve here is to build a reasonable client profile and ensure an understanding of the expected behavior in the relationship going forward. So it includes gaining an understanding about the client's background, about the client's source of wealth, and obviously source of funds, and also enhanced and more closer monitoring of the relationship and the transactional behavior. And whenever you see changes, obviously adjusting the customer profile depending on additional information you might come across in the course of the relationship. So again, essentially obtaining additional information on the customer, so more details about what the customer does, volume of assets available, information available through public databases, looking at the internet a bit more, doing some more research, and updating that data, the identification data of the customer more frequently, more regularly. Obtaining additional information on the intended nature and of the business relationship, the counterparties that might be involved, the frequency of the transactions, and the reasons for those transactions as well. High-risk situation means getting an additional person, a 4i, to look at the relationship, approval from senior management. And this is not because senior management knows more than we do when we're performing enhanced due diligence, but it's because senior management should be aware of the risks that we are essentially taking on. So obtaining approval from senior management is really important in high risk situations. And that would mean also at the same time a closer look at the relationship, more enhanced monitoring of the relationship, how the relationship changes by increasing the number and the time of the control. So essentially performing a review of the relationship more frequently than we would do in a standard CDD situation or a lower risk customer. And again, obtaining more information on the source of funds and source of wealth. And there's a definition here on the source of funds. A lot of times people confuse these two terms, source of funds and source of wealth. They have been used interchangeably in the past, wrongly, obviously, but it is quite simple to understand it. Source of funds is usually the origin of the specific funds that have to do with you, that are the subject of the specific business relationship between yourselves and your customers, where the source of wealth is essentially where the customer has derived the total wealth that they have declared. So, and also it's more important, not just to get information on the source of wealth, but it's more important to understand, whether the source of wealth, whether the information you have in the file actually makes sense. So if somebody comes to you and says, this is essentially my wealth has been derived from inheritance, and I'm 20 years old and I have 100 million that my dad gave me, does it actually make sense? And then you will need to go back and say, okay, so what was your father's occupation? How did they make up all this wealth? How did they come to have this wealth to pass on to you? So it's a lot of information, but more importantly is understanding that information and realizing that whether essentially understanding whether it makes sense. So be convinced whether the funds and wealth can actually be reasonably established to be legitimate, and perform that reasonableness test. Does it make sense? As simple as that. And one of the things that I usually say when I'm performing trainings is that we are in an industry, in different industries, and performing wherever you're working, you're performing all these cumbersome compliance tasks. A lot of times you get carried away and we stop thinking, but we just do. We need to use our brain. We need to think a bit more. We need to apply critical thinking, and that is really very important. There is somebody waiting, I think, Ian, in the lobby, but I cannot let them in. I cannot see them here.
No problem. I'm just taking care of it.
Thanks. Hi, Veda. How are you?
I'm fine, and you?
Good to see you here. Thank you. Okay, so and a lot of times we think about these things and they appear to be really difficult, collecting information from the customer. It is a legal requirement. We need to collect the source of wealth, but it's easier than it sounds if we actually put it into practice. A lot of times we just get the information by asking the customer the specific questions. It's not, and that's going back to my first slide, I said that knowing the customer well means transparency. And transparency should go both ways. I mean, the way you ask the question is really very, very important. If you tell the customer, I want to find out about your source of wealth because I am suspecting you of money laundering, or because I quit you of any of your crimes. It's very different to actually explain to the customer that this is a legal requirement. The more we know, the better we can actually service the customer. So most of the information you would get by talking to the client, interviewing the client, asking the right questions from the client, and collecting those information, those documents that the customer can can provide to you, and also reference that to publicly available information to ensure that you verify that the information you are being provided with is legitimate. And going forward, you can also review past transaction history, and you can also review information for existing customers. And during your review, you can actually go back and say, okay, is the information that I received at the beginning still valid? Does it still apply? Was it, looking back at the transactional relationship, again, whichever industry you're in, does it make sense? Was I given the right amount of information and the correct information? And is it still consistent with what I would expect from the specific customer? So things like documents are really important, because I always believe in a direct communication, in a conversation, but if you don't document it, it's like it never happened. So receiving some documents is really important, like things like pay slips or history of employment, and cross-referencing it with public information, even social media, right? Social media, you cannot really rely on them, because I can write on my LinkedIn page whatever I want, or on my Facebook page, I can actually write whatever I want, but it actually helps you either cross-reference information, or it helps you get some leads to other searches that we might be able to do. Things like evidence of title deeds or copies of trust deeds, financial statements or audited accounts, letters from employers, or confirmations from banking institutions. This is all very helpful to establish and to confirm things like source of funds and source of wealth, but also looking at public records and other public information. So I'm sure that a lot of you, if you have been involved in enhanced due diligence before, you can definitely think of specific situations where the information you have received was insufficient. I mean, what comes to mind is when I was working for a banking institution a lot of years ago, and we had a regulatory visit. At some point, they asked to look at the files of some of the bank's customers, and we provided them with these big red, box files full of documents. For one customer, we had 12 or 13 different box files. It was ages ago, but when the regulator started looking at the information, they realized that we actually had nothing in the file that was substantial. A lot of information that was immaterial. So it's not the amount of information that you collect, it's the quality of the information and how sufficient it is to help you establish and verify what you're trying to achieve. Adverse media, again, it has become a regulatory responsibility, and looking at things like newspapers, doing some internet searches, even using specific tools or specific vendors that can help you with your adverse media search. That's really important, because it brings in front of you a lot of information that might be worth looking into. So it's really important, though, to either have your reliable tools, but know how to use them, right? So it's important as in everything we do, governance is really important. So having specific policies and procedures on how to search, what to search, what data to use to search. If you don't have good and clean data and data that is of good quality, then any searches you do are hopeless or to a large extent useless. You can do your manual search by using Google or other search engines, or multiple search engines, or things like searching in if you're searching, for example, for specific things in Ukraine, it would be useful to even use search engines that are specific to Ukraine. You will be surprised with the different type of information you will come across. Obviously, it will be in a different language, but you can use a lot of tools to translate the information and make it work for you. Meta search engines, there are a lot of search engines on the internet which help you look at a lot of different search engines at the same time. And you can set up Google alerts and also do a lot of Boolean searches by using specific words to perform some advanced search. Very quickly here, what I will say here is check the source, check the author, ensure that what you come across is legitimate and is worth looking into. A lot of times you will come across fake news, a lot of media that is definitely adverse, but it's not valid or is not reliable. So look at the sources, make sure that what you are basing your decision on is quite reliable. So I have 3 questions that I always ask my my colleagues or the people I train to think about. It's 3 simple things. We've talked about a lot of things today, but it's 3 simple things. When whichever industry you are working in, whenever you come across a client, you need to know who the customer is. So understand who the customer is, if it's an individual, if it's a legal entity, the type of structure, the type of entity, if you have a PEP in front of you, and so on and so forth, what the customer is doing. So what is their profession, what industries are they involved in, who they associate with, and the third thing, and very important, is what do they want from you, and does it make sense for a customer who's registered in, I don't know, Vietnam, to come and work and seek an account or do a bit of gambling in Cyprus? Does it make sense? So what does the customer want from you is very important. We all want the business, but we do not want to be misused, and understanding the purpose of the relationship is very, very important. And that will define what should reasonably be expected. It will define your vulnerabilities, and so it will also define your controls, and also it will help you understand who is controlling the account and the decisions. So I think this might be the last slide here. Things to consider in a nutshell in enhanced due diligence. Again, the customer is good until proven otherwise. Sometimes we get paranoid, and we try to find ways to reject the client relationship, even if we cannot really find anything worrying, just because a client, based on the risk factors, poses higher than average risk to your institution or your industry. So what? If you're ready and if you have the right controls in place, you should not be afraid of the risk. Risk is to be managed and it's not to be avoided. So if you have your risk assessment and you understand the risk and you set up your controls, like your policies and procedures, and you have a right, a culture of doing the right thing across your institution, always try to have a story behind every single client relationship. If we're talking about high-risk customers, that is very, very important. It's, we use lists and you use boxes, we tick boxes when we're performing our due diligence, mainly to satisfy the regulator. But the essence, the reality is that we need to understand where the customer is coming from, what they're doing, and have a story in place. And that will also help guard you against the regulatory visit. A lot of issues sometimes they appear when we don't have enough information, or when the information is a lot but it's insufficient, when it's excessive and at the end of the day is useless. Enhanced due diligence is not static. Like due diligence, it's ongoing. It's a closer look at the relationship, a closer look at the transactional activity. And again, trust your instincts. Don't get paranoid. Customers are good, even if they pose a high risk to your institution. Find ways to manage it and get on with the business. I know I was rushing through it. I had a lot of things to say today, but I am open if you have any questions. I'm not sure if we have time. I think we ran over time.